United Airlines stock is barely budging after solid earnings. United Airlines had a good second quarter, but the stock barely moved. Bears fear operating problems and political volatility. God willing and the creek don't rise, the stock is a bargain. Let's dive in. Here's why United Airlines stock is a high-risk, high-reward buy. Welcome to Timely Investment Research. United Airlines stock had a muted reaction to record earnings this week. The company earned $881 million, $2.66 per share, under generally accepted accounting principles on revenue of $25.6 billion for the 3 months ending in June. This compared with a loss of $1.05 billion, $3.22 per share, a year earlier as total revenue jumped 30%. United reported non-generally accepted accounting principles earnings of $3.24 per share and a pre-tax margin of 9.8%, as it paid down $1 billion in high-coupon debt. Either the stock is an enormous bargain, or there's something going on below the surface for investors to worry about. A closer look at United Airlines stock. Airline stocks were volatile before COVID, but the pandemic buried many, including United. The company still has $19.6 billion in net debt, under generally accepted accounting principles, which turned $3.8 billion of operating cash flow to just $2 billion in free cash flow during the June quarter. The debt will take years more to clear. Then there are basic operations in a time of accelerating climate change. United's hub at Newark was hit hard by storms around New York in late June, creating gridlock and canceling flights across the network. Dealing with the problem will mean scheduling fewer flights, especially to Newark, which United had just made its international gateway. United now handles 57% of all flights there. After first blaming the Federal Aviation Administration for its problems, CEO Scott Kirby backed down, apologizing to Transportation Secretary Pete Buttigieg. It didn't help when Kirby flew to meet the crisis on a private jet. Fuel prices are volatile, and United's recent contract with its pilots will increase pressure on earnings. The agreement raises some salaries as much as 40% and will cost $10 billion over 4 years. The airline acted because the whole industry faces a pilot shortage. The bull case. The United Airlines stock price is attracting bargain hunters. The airline's expansion has been a financial success, and new routes to Asia will keep it growing. United starts flying direct to Manila in October and is also expanding service to Japan, Hong Kong, and Taipei. TempRanks currently lists 11 analysts following United, with 6 saying buy and just 1 saying sell. The average forecast of 19 analysts at Yahoo saw earnings averaging $9.73 this year and $11.19 per share next year, with half of them recently hiking their estimates. We recently called United one of 3 large-cap stocks to buy now. Airlines may be stumbling, but their stocks are not. The bottom line. If interest rates have topped out and the tech rally is broadening, United stock should benefit. Most airline stocks are still dirt cheap. The PE of Delta Airlines is below 11 and that of American Airlines is below 7. God willing and the creek don't rise, as the saying goes, United is a buy here. The problem is that God doesn't seem willing and the creek is rising. Climate change is creating uncertainty and wars aren't helping. The case for United is based on growing international travel, especially to Asia. It's also based on Kirby getting a handle on operating problems, which is also uncertain. But where there are big risks, there are also big rewards. The potential rewards with United are substantial. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.